Welcome to SB Talks. Today is Monday, October 21st, and I am joined once again by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be talking about strong Australian employment data, which is dampening calls for rate cuts, US retail sales, which are showing a resilient consumer, and Chinese economic activity, which shows some improvement, albeit off a low base. Welcome to all our listeners. Starting local this week, Nick, strong employment data. Fair to say that's dampened calls for rate cuts?
Yeah, so employment in September was much stronger than expected. We had 64,000 new jobs created. That was up from 47.5 the prior month and well above the market expectations of about 25,000. And a lot of the jobs were full-time. So
really resilient number in the job market.
Yeah, I mean, I think the current estimates are around 30,000 jobs are needed each month just to keep pace with the population and labour force growth to keep the unemployment rate steady. So we did have a lift in workforce participation to a new all-time high of 67.2%. So more people kind of coming into the workforce, more jobs being created. So a very strong number.
So that's really an impact of immigrants coming in, taking places in the workplace, helping to offset, I guess, the retiring out part of the population. So.
Yeah, I think also what we're seeing is obviously with the cost of living pressures, more people are kind of coming into the workforce. So maybe people that were maybe more marginal have sort of decided to take a job, and the jobs have been there for them to take those jobs. So that's why
participation piece.
Yeah, that's why participation's been strong, and it's something. Obviously the jobs are there, so that's good. But interestingly, I don't have the statistics in front of me, but a large percentage of the jobs that have been created over the past few years are in what they call the non-market sectors, so basically government type sectors, so the care economy, aged care, childcare, healthcare, rather than sort of private sector jobs. So there's implications for that, particularly around productivity.
Yeah, something to keep an eye on there, obviously,
Yeah.
in terms of government expenditure and commitments as well. We know the US is sort of that part of their economy, that payroll, if you will, for their economy has become huge, and it's become part of their struggle to get their budget back in balance. So, interesting one for you to call out.
Yeah. So it's a strong result, and we've really seen markets really push back the likely first rate cut in Australia.
So give up your 2024 rate cut dream.
Yeah, give those up. Not that we thought that was unlikely. February's still a chance. So it's 50% priced for February, but really April is where the market now is kind of locked onto for the first full rate cut. And some people saying, I think I might have mentioned on prior call that some people saying it could be even longer than that.
Round to the middle of next year.
Yeah.
And what is the market pricing in even beyond that point? Is it sort of pricing in many rate cuts in 2025?
I can't remember at the back end. I'm just looking at the sort of when the first one is. I think generally what we expect to see is if there's a first rate cut, then there would be, bringing it back down to sort of neutral, in that sort of 3.5 type range.
Which is not a huge way to go to get back to, say it was 3.5. There's, a few cuts and then we're there.
Yeah. Well, that's right. I mean, Australia never went as high as other countries, so the size of the sort of cutting cycle will be a lot shallower than other countries. So there's a
possibility we get a couple of 25 basis points cuts and then they sit for a while to just see what impact that has had on the economy.
Yeah, absolutely.
Might step across on the theme of sort of positive economic stories. US retail sales showing a continued really resilient US consumer.
Yeah, very strong numbers for September. So the core figure, which excludes sort of cars and petrol stations and things like that, that was at 0.7, and the prior month was revised up to 0.3. What they call the control group, which sort of strips out more volatile things like building materials as well as autos, that was up 0.7. That's the bit that goes into the GDP numbers. So just a very strong consumer. Really no signs of a slowdown, these fears of recession and all that sort of stuff, just not there. we might have discussed on prior calls, the US economy has been growing at around 3% in sort of Q2. And the current indications are that that's continued into the third quarter. So we'll get those probably later this month, the initial estimates. But yeah, another strong quarter in the US for growth, really driven by low unemployment, people having jobs and prepared to spend.
And we put that into the context of the US having done that 50 basis point rate cut, which was sort of an aggressive way to start their cycle, potentially now just a broadening of the feeling that they can probably go more slowly from here.
Yeah, we've had a few Fed speakers in recent weeks saying, well, maybe we need, we can go a bit more slowly, maybe skip a meeting. We don't feel that we necessarily have to do 25s at each meeting. So the market pricing for November is a 23, so it's a full cut. But then by December, 44. So the market's saying 1.5 cuts kind of between now and the end of the year. So yeah, there's not a lot of conviction that they'll be doing 25s automatically at every meeting.
Yeah, and
given the strength there.
Not insignificant event of the US presidential election to come between now and then. I think the next time we record in a couple of weeks will be just on the mouth of that election.
Yeah, I mean, it'll be interesting to see whether we actually know the outcome. It looks like it's going to be a very, very close race. It'll probably come down to a few thousand voters in a few of the swing states.
Pennsylvania's looking particularly key.
Pennsylvania will probably be the key one. Yeah.
Yeah, and potentially, hopefully not, but heading to the courts, some controversy around the vote count is probably likely, dare I say.
Probably, if it's close. I think the market's interestingly, just in the last few weeks, sort of maybe starting to price in a Trump victory. So obviously he's good for corporate taxes. Lower those, lower taxes, less regulation. There's still a question over the tariffs, what that might mean, but that favours domestic companies generally. So I think the market's maybe pushing a little bit more in that direction. Harris has lost a little bit of momentum that she had sort of post the convention and the,
definitely. And sort of having to get out there on the campaign scene a little bit more and do more interviews is just turning into a little bit more of a scrap. So anyway, we will see. It doesn't influence your positioning of portfolios, it's fair to say.
Not really. It's very hard to create portfolios, particularly when it's 50-50. The risks are sort of equally balanced either way. And it obviously affects different things depending on who wins and whether there's a red sweep or a blue sweep. So you might have Kamala Harris become the president, but then she doesn't control Congress, and vice versa. So there's a lot of different scenarios.
Markets generally probably prefer that there is a bit of balance across there because it theoretically stops anyone going too far in one direction.
Yeah, absolutely. And, Donald Trump's policies have been costed, sort of $7.5 trillion increase in the deficit over the next 10 years based on his policies versus Kamala Harris at $3 trillion. So that can have implications for the bond market and for the currency market. But he would obviously need to control Congress to get a lot of those tax cuts through.
Yeah. Watch this space. Last time we recorded, we were talking China. Obviously, we've talked many times on the podcast about some of the challenges that China has faced, particularly their property sector and the flow through to their consumers. China sort of stepped up its efforts in recent times. We had some announcements on the monetary side and had been hoping for, let's say, more on the fiscal front, but fair to say they failed to deliver as of yet.
Yeah, there's been some, some high-level comments about the government's ready to step in and provide more fiscal stimulus, but we haven't really seen the details of that. I think there is a meeting later this month of the NPC, which is sort of their version of the Parliament that needs to approve some of these things. So maybe after that we'll get some more details. But there's been a lot of speculation about special bond issuance and things like that might pump more money into the economy. The challenge they have, though, is, with a lot of these sort of bond quotas where they give governments, additional money that they're allowed to go borrow, they're also required to only borrow if they're investing in something that has a good financial return.
Right.
And it's not always, that's one of the reasons why a lot of them haven't even used their quota from this year, because they can't find projects that meet the required rate of return. So it's unclear whether
just how they would deploy that
throwing more money at them, whether that necessarily changes things dramatically.
Achieves anything.
But no, we did get some September monthly activity data out of China, and I would say it was better than expected, although expectations were set pretty low. GDP came in at 4.6% year on year in the third quarter. That was a little bit better than the 4.5% expected, but down from 4.7% the prior quarter. So it's the slowest growth in about 2 years. So it's, the economy needs something.
A jolt of sorts.
Jolt if it's to get to that 5% or around 5% that the government targets. Retail sales grew 3.2% year on year. That was better than the 2.5% expected. So, there's a little bit of a glimmer of hope that maybe the consumer is spending a little bit more, but then people say, that's just due to these government policies that encourage people to trade in their old cars and home appliances for more efficient ones. Right. So there was a bit of a
artificial
bump to those things. And house prices in September continued to fall, so down another 0.7% for the month, down 5.8% year on year for new homes. So
very hard to fire up the consumer when that's your backdrop. Your primary asset is declining in value. We see it all over the world, but China's no different. Yeah,
no different. I mean, they are, as we've discussed previously, one of the new stimulus policies is to try and put a floor under the stock market. So that seems to be working at the moment with these money for buybacks and equity swaps and things like that. But yeah, I mean, there's still some structural problems. There's the demographic headwind, there's the debt deleveraging, there's the deglobalization. These are all sort of longer term structural problems. So even if we get a bit of a short term blip, next quarter or in 2025, it's unclear to see how those structural problems get resolved.
You think about it, there's sort of two big factors at play here. One, the one-child policy eventually coming back to create a real demographic challenge for them, and it's going to be very hard to overcome it. And then sort of like the knock-on implications of COVID, where COVID really, I think, made a lot of people in a lot of regions of the world wake up to the fact that there's limitations to globalization, and when that chain breaks down, you need to have, I guess, alternative sources of supply, or particularly for certain critical products. So I think that's probably compounded some of the challenges for China, on top of what was probably already a natural slower down point after, let's call it a few decades of rampant growth.
Yeah, no, absolutely. All these things have come at the same time. So you're right.
And the oil price has sort of been sliding back a little bit in recent times. The Chinese demand, a factor there. The last time we spoke on the podcast was not long after the Iranian strikes in Israel, and I guess huge fears at that stage of what might play out from there. It hasn't probably escalated to the degree that worst case scenario that had been feared, but the oil market seems to be moving past that, at least in the short term.
Yeah, I think on the last call we spoke about how went from I think around $70 up to over $80 just on fears around Israel striking Iranian oil facilities. It's come back down as I think people have taken the view that Israel, if they did retaliate, it would more likely be military targets rather than energy or nuclear facilities.
An excellent summary as always, Nick. Thank you once again.
Thank you.
And thank you to all our listeners. Take care.